Okay, here we go. The last two financial statements we're going to work on. And those will be the extended income statement and the extended balance sheet, basically. And the extended income statement, instead of doing that monthly income statement for another 4 years, we're just going to do some annual estimates of what our company's going to look like, or how the sales and whatnot are going to be over the next 4 years. Okay. So what I want you to do, there is a 4-year one, I think, that's right there, if I'm not mistaken, on D2L. Let's go take a look. This pro forma income statement, if you were asking about income statement, then you're right. The pro forma one should be the 4-year one. If you guys have opened that, does it look something like this? I hope. Okay. The dates up here, obviously, you need to change. It's an old template that SCORE did years ago, and that's what they had, so we're going to change those to more modern dates. Then, what I want you to do, okay, the very first thing that you do is that you look at your, and I should have brought one up, but look at your monthly income statement that you've completed, and in the far right-hand side, there is a total column. Okay, that total column will go in this. This will be your first year, right? Doesn't it?
Yeah, we have a different one.
Well, let me call up the one that's on D2L then. Maybe I got an updated template and I didn't put it into my file, but I put it on D2L. Let's see here. Oh, a little different. Okay. Either way, roughly the same thing. Still got bad dates up here, so change the dates, right? But same thing. Use this first column. Okay, needs to be just the totals from your monthly income statement. Okay, your 12-month income statement. Just the totals. Right? So that's basically annualizing it. Then what we're going to do is take the next few years and we're going to make some assumptions, right? Okay, and you can make the assumptions that you think are appropriate for your business. That's fine. Okay, and so the assumption might be in some cases, you know, John's probably going to have a relatively slow growing business. We hope that he grows some, but maybe it's 10 or 15%. Okay. And I don't know what John's going to use. Okay, it could be 25%. That's fine. If he can kind of justify that, that's fine, right? Okay. So if your gross sales here were 500, and then you just say, okay, well, if my business is going to go up 10%, I'll use, and I can just say this is the. Oops, I got to hit my enable editing. So this is equal to, you know, this times 1.1 in that case, right? There's a nice 10% increase. And maybe I want to go 10% the next year, and maybe 10% the year after that. I'm going to have consistent 10% increases. Okay. If you have sales and returns and allowances, most of you I don't think are doing businesses where that's the case. Okay. Cost of sales or cost of goods sold. This one gets a little bit weird. And if you want to, you know, I don't really care because none of us are doing, I don't think, manufactured types of things anyhow. Because I think what this is talking about, it's talking about like work in progress and those types of things that I don't think any of us are doing. So if you want to, you can basically come down and work with the total cost of goods sold. If that makes sense. You could delete all of these, that's fine. You could even delete the lines, I don't care, right? If you're doing a straight retail type of a business, you're just going to have a cost of goods sold, so work with that line. Okay, does that make sense? If you've got something that's a little bit more complicated than that, we do need to work with this, holler at me and we'll work on that individually so we don't take up everybody's time. That's going to give you your gross profit, much like on your income statement, right? Okay. Then you've got your other expenses. They break it down in a couple different categories here. Most of us don't have, right, these expenses up here. These would be commissions, other types of selling expenses. Those other, you would have your advertising, I'm sorry, right? And you would have your depreciation, I'm sorry. Okay. And then you just fit them in. Okay. Now what's important with this and what we want to see in a company is this, is that you're going to have some costs that are truly fixed costs. Maybe your rent, right? Maybe you signed a rent agreement and you're going to rent that place for $400 a month and you're getting that for 4 years at $400 a month. Boom, that's going to stay the same, right? Your interest should hopefully come down a little bit every year, right? And you're going to get that interest right off your loan amortization. So because you're paying down principal, your interest should come down a little bit each year, right? And so hopefully what we see is even if we have a modest increase, just a modest increase in our sales, we're able to decrease at least slightly some of our operating expenses so that our profit increases dramatically over the years, right? Or reasonably at least over the years. Does that make sense? Some of your other costs are probably going to increase, and you're maybe just going to have to make some assumptions again about that. Do you think your insurance is going to stay the same for 4 years? No, it's probably going to go up, right? Okay. So you're going to have to calculate that it's going to go up. Do you think your utilities are going to stay the same? No, they're probably going to go up. You know, are your supplies going to go up? Yeah. Now, the assumption might be if your sales go up 10%, that those things might only increase. You know, normal inflation rate, like for supplies right now, inflation's running about 2%. You know, if you wanted to be a little bit conservative, you might put a 3 or 4% increase in your supplies, right? Because they should stay in that range of inflation, right? Fuel's interesting. For those of you that have fuel, I don't even know where to start to tell you, because we've seen fuel costs drop by about half, right, in the last 6 or 8 months. Now, do I think they're going to stay this low? I think they're going to go lower, and then I think they're going to start coming back up. So, but boy, that's a bit of a crapshoot. So I'd probably maybe figure some low amounts for this year, for our first year, but then figure that it's maybe going to start back up. What other things are on there? Payroll, you know, are you going to increase your salaries for your employees if you have payroll? I would think so. Right? How much? I don't know. That's up to you guys. Benefits, those types of things. Okay, so just go through it, and each one, just go through it line by line, and the ones that you actually have, you know, think it through. Is this one going to change, or is this one going to stay the same? Or is it possibly going to go down like our interest is going to go down, right? It should. Does that make sense kind of to everybody? Don't make it any harder than it is. We're just kind of taking and making some assumptions, and away we go. Okay, and you should end up with a net income. Now, you know what? Let's say your net income for your first year is $100, just a rough number. You know, and your sales are going to go up 10%. You know, if your net income goes up to $200, I'm probably going to be. I mean, that's a red flag, right? I'm going to look at that and say, wait a minute, our sales went up 10%, and now we're going to increase our profit by 100%. I'm not sure that that's accurate, right? So take a look. Okay, and make sure that those things just kind of make sense. Oftentimes numbers can kind of jump out at you if they're a little out of whack, so pay attention. Okay, clear cut on the income statement. So it's just on an annual basis. We're not breaking it down by the months. We are going to do, you know, the 4 years, the 1 year, you know, that we've already done basically, and then 3 more years. Okay, so then we jump ahead and we go to our balance sheet. Now, all I want you to do on the balance sheet is pretty simple. Take the balance sheet that you've been using. Is that the projected? Where's that? Okay. Copy, you know, this column. Just copy it over, right? So we get several more years, and we're going to need, let's see if we have, this is the end of year 1, so we'll need 3 more beyond that. So we'll actually end up with 5 columns of data here, because we'll have a historical, end of year 1, and then 3 more years of ending balance sheets. Does that make sense? Okay, how do we fill that in? A lot of the things kind of stay the same, right? You know, our cash, the cash number is going to become, because we're not going to do multiple year cash flows. So write this down or remember this. Please commit this to your mind right here. Your cash number is going to become what I call your plug number in subsequent years. What do I mean by a plug number? That's the number you're going to put in there to make your statement balance, okay, in these subsequent years. Okay, if you come down it then, accounts receivable, inventory, if your inventory stayed the same from here to here, it's probably going to stay the same next year, right? Okay. At this point, you could start saying, maybe I'm going to have to increase my inventory. That's fine. Okay, we can make some assumptions like that. I don't have any problems with that. Prepaid expenses, this might be like your utility deposit, rent deposit. Okay, if it went from historical to the projected, it's probably going to stay on the subsequent years as well. Okay, your machinery and equipment, furniture, fixtures, all your fixed assets are going to stay the same unless you think 2 years from now, your guys' business might be one in particular, right? Maybe in the third year you're going to buy a canning machine or something, right? I've heard Mike's already considering some things like that, okay? And he's been in for a year, right? And so you might then have to project some different things there, some increases in those types of things, right? Okay. But otherwise, for most of you, this is going to stay the same, right? Your accumulated depreciation, this is important, right? So your depreciation from your first year is at the far right-hand side, right, of your income statement. Okay, let's say it was $1,000. Okay, accumulated depreciation then for the next column is going to be how much? It's going to be $2,000. For the next column, it's going to be $3,000. And for the next column, it's going to be $4,000. The only exception to that, I think, if we get out there to that fourth year, is that if you had some 3-year property, then your depreciation might run out for parts of that, right? So your accumulated depreciation then would actually, it would stay at least the same, but it might not grow the full $1,000. Tangibles, deposits, goodwill, I don't think any of us had any of those things. Anybody remember what like goodwill is? We ever talk about that? Just briefly, this is just a lesson, but goodwill is oftentimes what a buyer might pay for a business over and above the actual book value of that business. Okay, so you might go down, there might be a building and some property for sale and equipment and whatnot at some little business down here. Okay, and if you added it all up, if you had the property appraised, this and that and the other thing, maybe it's worth $100,000. Okay, but the business owner's got a pretty successful little business going, making lots of money and doing pretty well, and the business owner thinks the business is worth $150,000 just based on the income and cash flows and whatnot that are generated. And that may be true. Okay, what happens then is that you end up booking something here that's called goodwill. Okay, the goodwill is the difference then between the actual value of the property, the $100,000, and the $150,000 that you actually pay for that. And goodwill can be amortized and different things. Okay, tax-wise, you can do some different things with it. So, okay. Accounts payable, interest payable, no. Taxes, maybe if you got some real estate, right? Notes short-term. Garrett's the only one that's got that going on. Current part of long-term debt. So this was the second 12 months, right? So the next column is going to be what? The third 12 months, and the next column is going to be the fourth 12 months, and the next column is going to be the fifth 12 months of principal payments, right? So we
only added 3 columns after the...
Yeah, you'll do 3 more columns here. You'll have historical, projected, and then 3 more. Okay, if your loan amortization is only 3 years, okay, you already got first and second, you're going to have 1 more column with principal portion. Then your debt should be gone, right? I mean, then you should show up that your debt's gone. Okay, bank loans payable are going to keep doing exactly like these arrows are, right? So each column, you're just going to keep doing that same thing. You can copy and paste the formula over. It'll take care of that, right? So your debt should continually go down. Now, again, we might be looking at a business like the brewery that says, no, by God, in third year we're going to buy canning equipment, this or that or the other thing, and so we're going to have to borrow another $150,000, and we're going to have to make some estimates like that, maybe. I don't know if that's what you guys have planned, and you know, it's not that difficult to do in the third or fourth year, whatever that is. So holler at me. Okay. Same thing down here then. Okay. We're still going to have, because we've already done our income statement for the next few years, that will be our retained earnings, right? Okay. Now, retained earnings are kind of like our debt up here. So we got retained earnings at the beginning, which we didn't have any here, but we had retained earnings current. This retained earnings current is going to go up one level and over, and it'll become our retained earnings at the beginning. And then we'll have retained earnings that we get from our income statement for that next year, right? And that'll keep going. Actually, then these two will be added together to get the next year. Does that make sense? Let me give you some examples here. So let's say that okay, both of these are zeros, right? 0 and 0. This one's 0, but let's say I got $100 here of retained earnings. Okay. Then let me try to do this. Insert and insert, and then I'll just go copy and paste. Okay. So my retained earnings here are $100. Now I copied it. I want to delete that, but so that my retained earnings here at the beginning will be $100. Then whatever my income statement says for that next year, for that annual, maybe it's $150. Okay. Bless you. Okay. Then my retained earnings here, I've got to add both of these together, right? Because retained earnings continue to accumulate. Okay? Except, I'm sorry. Minus your owner's withdrawal, so it's going to be all three of these. So my owner's withdrawal here might have been $50. Sorry. Then my nope, I was wrong. Sorry. I was right the first time. $100, so 100, so there's 150, so then this becomes 250. You know, and maybe I make $200 here, right? Then this one's going to become 450. Okay. And then I'll take out my owner's withdrawal each time, and that'll adjust that'll be the reconciliation of my owner's equity down here. Sorry, I didn't think that through very quickly. And again, so you're going to do all this stuff. You're going to leave the cash part blank, and you're going to do all this stuff down here. You know, you're starting down here. I'm sorry, inventory, prepaid expenses, and on down. You're going to do all of that, and you're going to get all done. And your total fixed assets should be less than your total liabilities and equity. So if my total fixed assets here then said that they were $200. Okay, so my total assets, I'm sorry, if my total assets said they were $200, apologize, and my total liabilities and equity were $250, then I'm just going to come up here and I'm going to take $50 and put it into my cash account, and then my balance sheet will balance. Okay, that's what I mean by using that cash number for a plug number. If you got questions about that, if you do as we go along, just holler. Yep, just the difference between whatever you arrive at in terms of your total liabilities and equity minus whatever your total assets are to that point. Yep, and then you just add the right amount of cash to make it balance. Because we're not doing future cash flows like that every year. It'll make sense as you get into it, I think, a little bit more. So you guys can holler at me if you got any questions. Any questions, other questions now? I will shut up and let y'all get to work. So.